Are conventional banks different from Islamic finance? Are you curious about how conventional banks differ from Islamic finance? Let's break it down in simple terms. Conventional banks operate mainly on an interest-based model. This means they lend money and charge interest, known as riba, as a fee for borrowing. Their primary goal is to make a profit. Interest is a key part of their products, which include loans, mortgages, and savings accounts. Conventional banks can invest in a wide range of businesses without worrying about ethical or religious guidelines. They mainly act as lenders and do not usually engage in trading or business activities. Their operations follow secular laws and regulations. On the flip side, Islamic finance is guided by Shariah law. This law prohibits charging or paying interest. Instead, Islamic banks use profit and loss sharing principles. This means both the bank and the client share risks and rewards. All financing must be backed by tangible assets, which means that transactions should be linked to real goods or services. Speculative activities are avoided. Islamic finance also forbids investments in industries seen as harmful, like alcohol and gambling. Unlike conventional banks, Islamic banks actively participate in trade and business, acting as partners rather than just lenders. They have a Sharia supervisory board to ensure all products and transactions align with Islamic principles. Let's look at some key differences. In Islamic finance, interest is prohibited, while conventional banks relying on interest-based lending. Islamic finance promotes risk sharing and profit sharing, while conventional banks offer fixed interest returns. Islamic finance has ethical investment restrictions, whereas conventional banks have a broader investment scope. Financing in Islamic finance must be asset-backed, while conventional banks lend based on creditworthiness. Lastly, Islamic banks are involved in trade and business, while conventional banks primarily provide loans. Practical applications in Islamic finance include products like Mudarabah, which is a profit-sharing partnership, Musharakah, a joint venture, and Ijarah, which is leasing. These replace conventional loans. Conventional banks typically offer fixed-interest loans and savings accounts. The aim of Islamic finance is to promote fairness and transparency in financial dealings, aligning economic activities with ethical and religious values. These differences are essential for ensuring that financial transactions comply with Sharia, promoting an economic system free from exploitation and unethical practices. While conventional banking works well in many situations, it does not align with the principles of Islamic finance due to its reliance on interest and speculative activities.